For years, the tax rules for employer-provided education benefits have felt like a moving target, right? Well, recent legislation has finally locked in some major changes, creating a whole new playbook for employers and tax pros. So today, we're going to do a deep dive into that new playbook, really focusing on the two pillars of education benefits, Internal Revenue Code Sections 127 and 132.
And this isn't just some temporary fix we're talking about. A landmark law has permanently reshaped these tax breaks, which finally ends that whole cycle of last-minute extensions we got used to. So if you're in benefits, payroll, or tax strategy, really understanding these new permanent rules is absolutely critical, not just for compliance, but for staying competitive in the talent market.
The real game changer here is what we're calling the One Big Beautiful Bill Act of 2025, OBBBA for short. Now, this is just our placeholder for some huge real-world changes that happened recently. It made two massive moves. First, it made the tax-free treatment of employer-paid student loans a permanent part of the tax code under Section 127. Huge. Second, it finally addressed the fact that the $5,250 annual cap hadn't changed in decades by indexing it to inflation starting in 2026. This has really ended years of uncertainty and opened up some brand new strategic opportunities.
Okay, so here's our roadmap for today. We'll start with the new tax landscape, then we'll break down the two key code sections, 127, which is our safe harbor, and 132, the safety valve. Then we're going to jump into the new trade battleground to look at some critical court rulings, get into the weeds of payroll and compliance, and finally, pull it all together into a strategy for designing your own hybrid plan.
All right, let's start with the foundation, Section 127. The best way to think about this is as the safe harbor. It's the most straightforward, no questions asked route for providing tax-free educational assistance, and it's pretty much where most broad-based programs begin. Now, safe harbor doesn't mean there are no rules. Oh no. The requirements under IRC Section 127B are super strict, and if you mess up, you could disqualify the entire plan. You've got to have a separate, written plan document, no informal promises. You also can't offer employees a choice between the benefit and cash. You have to provide reasonable notification to all your eligible employees, and, this is a big one, there are non-discrimination rules. No more than 5% of the total benefits paid out can go to owners who hold more than 5% of the company. And it's all capped at that annual limit, which, thankfully, will finally start going up with inflation. And here's one of the biggest changes. What started as a temporary measure in the CARES Act, it's now permanent. Employer payments toward employee student loans are now officially considered educational assistance under Section 127. But here's the crucial point. This is not a separate pot of money. It all gets aggregated with any tuition reimbursement under that one single indexed annual cap. Okay, this slide really lays out the fundamental tension in education tax law. On the left, you've got Section 127. It's simple, you don't have to prove job relatedness, it includes student loans, but it's capped. On the right, you have Section 132. Unlimited benefits. We're talking huge amounts. But job relatedness is strictly required, it excludes student loans, and it brings in this really critical, complex hurdle called the new trade or business test. Getting this division is the key to everything else we're going to talk about. So let's talk about Section 132, specifically subsection D, which covers working condition fringe benefits. This is our safety valve. It's what allows an employer to provide unlimited, tax-free education benefits. Think a $100,000 Executive MBA. But, and this is a big but, only if it can clear a series of very high hurdles. And those hurdles are laid out in Treasury Regulation 1.162-5. You can think of it as a two-step gauntlet. First, the education has to pass a positive test. It has to either maintain or improve skills for the employee's current job, or be required to keep that job. Then it has to pass a negative test. This means it has to avoid two disqualifiers. It can't be education needed to meet the minimum requirements for the job, and it cannot be part of a program that qualifies the employee for a new trade or business. And let me tell you, that last one, that's the real minefield. Which brings us to the most complex, the most heavily litigated area of all of this, that new trade or business standard. To really wrap our heads around this, we can't just look at the code. We have to look at how the tax court has interpreted it over the years. I mean, this is the million-dollar question. And sometimes it's literally a million-dollar question. When does an advanced degree, like an MBA or a law degree, stop being just an improvement of your current skills and start qualifying you for a whole new profession? The answer determines whether a $100,000 reimbursement is tax-free or fully taxable wages. And the key concept really comes from this landmark case, Almire versus Commissioner. The tax court established this precedent that the change in duties has to be an evolution, not a revolution. This single idea became the foundation for how employers can approach those really high-cost degrees like an MBA. And the courts really built on that idea. So in Almire, you had a salesperson who got an MBA and became a manager. The court said that's an evolution. This is basically the bedrock case for tax-free MBAs. Then in Long, an engineer's MBA with a bunch of finance courses was tax-free because it improved his skills for his tech management job. This shows it's totally okay for technical staff to learn new business skills. And in Singleton Clark, a nurse's online MBA in healthcare management was seen as a natural progression, which is great because it validates specialized and online degrees. But whoa, there are definitely some clear traps to avoid. In Glan versus Commissioner, a CPA got a law degree. The court said, look, it doesn't matter if you intended to stay a CPA, a JD objectively qualifies you for the new trade of being a lawyer, so the deduction was denied. Then you have Link versus Commissioner. A recent rad worked for just 3 months before starting an MBA. The court ruled he wasn't yet established in a trade or business, so he didn't really have any skills to maintain or improve yet. The big takeaway here, experience really, really matters. So what happens when a benefit is deemed taxable, like that law degree in the Glenn case? What actually happens next on the ground? This is where we move from legal theory to the practical mechanics of payroll and compliance. How do you actually handle the withholding and reporting? Okay, so when tuition reimbursement is taxable, it's just treated as wages. Simple as that. Now, to soften that blow, a lot of employers will gross up the payment. This just means they pay the taxes for the employee, so the employee gets the full benefit that was intended. The calculation is a little tricky, though, because the tax payment itself is also income. But this formula right here, this solves that puzzle for us. Let's walk through a quick example. Let's say the employee gets $5,000 in taxable tuition. You add up all the applicable tax rates. We'll just assume a total of 34.65%. You then divide the net benefit by 1 minus that tax rate. So here, it's $5,000 divided by roughly 0.65, which gives you a total gross pay of about $7,651. The employer reports that as income, withholds the difference, the $2,651, and the employee walks away with their full $5,000 benefit, totally tax-free to them. Pretty cool. When you're doing that withholding, these are the key federal rates for 2026. For most employees, you're going to use the optional flat supplemental rate of 22%. But you have to be really careful here. If an employee has already received over $1 million in supplemental wages for the year, the federal rate becomes a mandatory 37%. And of course, you've got your standard Social Security and Medicare taxes right on top of that. All right, we've covered the law, we've walked through the court cases, and we've dug into the payroll. Now let's bring it all together. How do you design a policy that is both compliant and competitive and really maximizes that tax-free benefit for your employees? Just as a quick refresher, here's that core division again. Section 127 gives you that simple indexed cap for pretty much any education, and that includes student loans. Section 132 offers an unlimited benefit, but only for strictly job-related education that does not qualify the employee for a new trade. The best practice approach actually uses both of these.
The solution is what we call a hybrid plan. It's a really smart 2-layer system. Layer 1 is your Section 127 base. You reimburse everyone up to that annual index limit for any accredited education or student loans, no questions asked, 100% tax-free, simple. Layer 2 is the Section 132 excess. For any amounts above that limit, you require substantiation. You need a business case, a manager sign-off confirming it improves current skills and isn't a new trade. And if it's properly documented, that excess amount is also tax-free.
So the final question to ask yourself is this. With student loan repayment now a permanent fixture and the rules around high-cost degrees much clearer thanks to the courts, is your company's policy built not just for compliance, but to be a real competitive tool for attracting and keeping top talent? You know, now is the perfect time to find out.